If you ask a random person right now if we're in a recession, there's a decent chance they say yes. For decades, we've defined recessions as 2 consecutive quarters of negative GDP growth, and we saw that in the United States in 2022, but the Biden administration sought to change the definition of a recession instead of actually trying to fix the economy. The media bought this charade hook, line, and sinker and has maintained that we aren't in a recession, but we are on the brink of one. The reality is that we are in a recession right now, and we're actually on the brink of a depression. Banks and financial institutions are always those who take things too far, and when a depression rears its ugly head, many of those banks will collapse, and today we're looking at the warning signs telling us that that collapse is near. We're looking at the biggest bank in the world, its own CEO's prediction that 2023 will be a terrible year for the economy, and an independent analyst's prediction that this turmoil will even bring that specific bank down. Yes, we're talking about the year that just might bring an end to JPMorgan Chase and the chaos that will follow. A few weeks ago now, Jamie Dimon, who has been the CEO of JPMorgan Chase for about 2 decades now, came out and made some incredible predictions for the coming year. He started off tackling monetary policy and what he thinks the Federal Reserve will do, and on the surface, his prediction seems quite normal. He thinks that the Fed will continue to hike interest rates up to about 5% and then hold them at that rate in the hope that this will put a dampen on inflation and prices will finally stop rising. This is known as the terminal rate, and it's a big deal when it comes to investing, so the world bets on it, and currently the estimated terminal rate from the Federal Reserve themselves is 5.1%, putting Jamie Dimon right about that mark. At the end of 2022, rates are sitting at 4.375%, meaning there isn't much more hiking to do, and many investors think this is bullish, that the hawkish Fed is almost over, and that following this, the economy will recover and stocks will boom again. The problem is that Jamie Dimon doesn't think this will be enough to curb inflation, and that's a serious problem for what's about to come. He thinks inflation will remain high and might even spike back up, even though interest rates will be at 5%, and even with the damage that will do to the economy. Dimon is focusing in on consumer savings, and his theory is essentially that people have just been dipping into their savings pots over the last year as inflation has been sky high, and that's why the economy hasn't yet tanked. Inflation is eroding everything I just said, and that $1.5 trillion of consumer savings will run out sometime mid-next year. So when you're looking out forward, those things may very well derail the economy and cause this mild to hard recession that people are worried about. Consumer savings in the US, in short, are dropping by the day. Right now, the personal savings rate is the lowest we've seen since 2005, right when the global financial crisis was about to explode. And once consumer savings run dry, then everything will change, and that is actually when the economy will crash. The issue with this is that the Fed is going to expect the economy to slow down gradually as they raise interest rates, whereas Dimon predicts it won't slow down at all right up until the point it drops off a cliff. He thinks we'll see the Federal Reserve hike rates to about 5% and wait for a few months for their tightening to get to work, but inflation will remain high as people just watch their savings accounts slowly deplete, and then the Fed will feel it has no choice to start a second rate hiking cycle, moving up to 7, 8, or even 9%. It's at this point that the consumer will finally be tapped out, that the savings they've built up over the last 5 years will dry up, and suddenly consumer spending will drop off a cliff and the economy will crash. Interest rates sitting at their highest levels in 40 years will make the whole thing so much worse, and the recession that is already really present will evolve into a depression rivaled only by the Great Depression of the 1930s. Just to make everything that much worse, Dimon is also expecting other problems to pop up, with geopolitical tensions worsening as seen regarding Ukraine and Russia and Taiwan and China, and humanitarian crises which always seem to emerge at the worst possible time. We've not had a war in Europe like this since 1945, and back then we said never again. Add to that, by the way, a lot of emerging market countries that a lot of people don't focus on are going to pay a heavy price to the strong dollar, higher rates and higher oil prices, and so that stuff is really significant. I don't think we've seen that kind of turmoil in the global world in a long time. Simply put, the man who has spent the last 20 years growing and expanding the world's largest bank is openly worrying about the next year and actually predicting that everything is going to fall apart. That's not exactly good news coming from someone who has a track record of knowing exactly what he's talking about. Really quickly though, if you want to know exactly what you're talking about and stay up to date on investing and finance news, the single best way is by signing up to my email newsletter with the link down below in the description. It's replaced the old series I used to do on this YouTube channel where I cover everything that happened and keep you up to date on investing and finance news. It's 100% entirely free and you can always unsubscribe anytime you want, so make sure to sign up to Stoic Markets with the link down below in the description. Unfortunately though, Jamie Dimon is missing something out on purpose. He's not talking at all about how this whole ordeal will impact his business, and that's something he just outright rather you didn't know. When it comes to this matter, independent analysts are left in the dark trying to figure out what's really going on, and this one seems to think that things aren't going so well over at JPMorgan. Christopher Wallen, who runs a global advisory firm, suggests that the estimated $2.2 trillion in capital held by banks all over the world is actually worth a mere fraction of that. When the true values of these assets are taken into account, it's actually practically worthless. Right off the bat, Christopher doesn't look at tangible equity, which includes the value of goodwill and deferred assets, and instead he focuses in on book equity, which cuts that $2.2 trillion of capital down to just under 1.5. He then took a look at certain bonds and assets that now actually provide negative returns to their investors, and he noticed that banks haven't updated their values on their books, which brings that $1.5 trillion down to just over 1.2. Next, he takes a look at the assets which have lost market value over the last few years. Think assets like Tesla stock, which has fallen 69% over the course of 2022, and he uses their current market valuations instead of the valuations these banks would like them to have. Now that $1.2 trillion has just been cut down by a further $1.7 trillion to negative $500 billion, forcing banks all over the world into insolvency if they were using this more transparent and straightforward way of valuing assets. Finally, he adds in the losses these banks have taken according to current market prices on their holdings of US Treasury securities, and that forces the number down another $800 billion, putting banks all over the world into a $1.3 trillion shortfall at the end of the second quarter of 2022. And of course, as we all know, the markets are lower now than they were in mid-2022, which means these things might even be worse than this analyst makes out. Now, there are some problems with this idea, the most important thing being that banks aren't forced to mark their asset values to current market values, so that $2 trillion loss isn't actually recognized by any bank out there. But should these banks find themselves in some trouble, or should they actually try to sell their assets and just hold cash, well then that $1.3 trillion hole would categorically exist, at least at current market value. As for JPMorgan in particular though, well, Christopher looked at them as well, and he puts that bank as being $58 billion underwater. That might just explain why Jamie Dimon is refusing to talk about how this economic collapse that he's predicting is going to impact his business. Needless to say, but things really aren't looking good here, and after what we saw happen during the 2008 global financial crisis, with banks like Lehman Brothers and Bear Stearns collapsing outright and many more needing a bailout from the taxpayer, well, the situation could easily end up worse. Back then, we really only had one bubble in housing prices and in mortgage assets based on that housing bubble. But in the post-COVID economy, we've seen bubbles pop up in almost every place imaginable. Real estate prices rose by a ridiculous amount over the course of 2 years. Tech stocks exploded in value even when they had no path to profitability. Crypto and NFTs went from not even existing in the years prior to suddenly being worth multiple trillions of dollars, and even car prices exploded along with weird luxuries like Rolex watches, which the world suddenly convinced themselves were actually investments and not just mindless luxuries. Our economies went insane as money printers were turned on all over the globe, and we are finally now reaping the whirlwind. As for what's next, well, no one can really say for sure, but crashes don't happen overnight despite what you might think. When we go back in time and look at recessions and depressions, we always tend to pinpoint everything on a single instance in time, Black Monday or the Lehman Brothers collapse for example, but the truth is that those were only tiny parts of the greater picture. The dot-com bubble peaked halfway through 2000 and stocks kept falling steadily until early 2003, about 2.5 years later. The global financial crisis saw stocks peak in mid-2007 and they kept falling until early 2009, a year and a half later. The Great Depression lasted for 6 years, but we all find ourselves looking at the COVID crash, expecting everything to fall off a cliff over the course of a couple weeks before a bull market starts back up again and stocks start to rise. The reality is that this practically never happens, and this last year, 2022, has proven that COVID and that crash was an enigma. At the very least, we have another 6 months to go for this bear market. A more pragmatic prediction says 12 to 18 months, and a pessimistic one says we have 2 or more years of stocks falling steadily but slowly. There will be bad days and there will be good days along the way, but the trend will be decidedly downwards. The best thing we can do to protect ourselves during all of this is just to keep paying attention. There's this idea that market peaks and troughs are marked by fear and greed, but I don't think that's true. I think that peaks are marked by euphoria, a belief that everything has changed and there will never again be a market crash, and troughs are marked by apathy and total pessimism, a belief that it's impossible to ever make money investing again. Don't be one of those people who see their investments fall day after day and week after week only to give up when you should be buying in. Pay attention to the news, keep reading and learning about our markets, and when the taxi drivers have gone from telling you how to make your first $100,000 investing in NFTs to telling you that investing is a scam where only the elites can win, that's when it's time to dive back in. If you want to see what BlackRock, the largest financial institution in the world and something far, far larger than JPMorgan, is expecting for 2023 and how their self-proclaimed new world order will change everything, then this video right here is the one for you. And of course, don't forget to sign up for our totally free email newsletter, Stoic Markets, and of course, stay stoic.